Opendoor Technologies, trading under the ticker OPN, is currently priced at $8.83.5, reflecting a significant intraday drop of 4.87%. The stock has been highly volatile, with a day's range between $8.41 and $9.31, and a staggering volume of over 118 million shares already traded. This sharp downward movement today is jarring, especially for those who have watched the stock's meteoric rise this year, and it immediately begs the question, is this a temporary pullback, or is the market beginning to question the sustainability of Opendoor's recent rally? Many investors have piled into this name, captivated by the narrative of a tech-driven real estate disruptor. The expectation is that Opendoor, as the last major iBuyer standing, is poised to dominate a recovering housing market, leveraging artificial intelligence to achieve what others could not. However, the reality of today's price action suggests a much more complex and uncertain picture, one where macroeconomic pressures and fundamental business model questions are colliding with a story of technological promise. The common belief surrounding Opendoor is that it's a straightforward bet on the housing market's recovery amplified by a tech wrapper. With interest rates expected to ease, the thinking goes that iBuying will become more attractive and Opendoor will reap the rewards. While there's some truth to this, it's a dangerously simplistic view. The deeper reality is that Opendoor's success is far less dependent on the direction of the housing market and far more on its ability to manage razor-thin margins in a capital-intensive business. The recent sell-off could be a sign that the market is waking up to this fact. Today's trading session has been marked by heavy selling pressure, indicating that institutional investors may be taking profits or repositioning ahead of potential headwinds. The high trading volume, well above its average, suggests that this isn't just retail sentiment at play. There are large blocks of shares moving, which often signals a shift in institutional conviction. This is a critical point that many retail investors, perhaps using platforms like Robinhood or SoFi Invest for their online investing, might overlook. It's not just about the direction of home prices, it's about the cost of capital, the speed of inventory turnover, and the accuracy of their pricing algorithms. The recent price action has been a roller coaster. After a period of consolidation, the stock experienced a significant breakout, but today's sharp decline threatens to erase a substantial portion of those gains. This volatility is a hallmark of a stock that is driven more by narrative than by fundamentals. The expectation of a new CEO, 𝐂𝐨𝐶, formerly of Shopify, bringing an AI-powered solution to the complexities of home flipping has fueled much of the recent optimism. However, the reality is that implementing such a strategy will take time and significant investment, and there's no guarantee of success. The market's initial euphoria may be giving way to a more sober assessment of the challenges ahead. The recent increase in short interest in Opendoor also suggests that a growing number of investors are betting against the company's ability to deliver on its promises. For those engaged in self-investing, it's crucial to look beyond the headlines and examine the underlying mechanics of the stock's movement. Delving into the company's business model, Opendoor operates as an iBuyer, a company that uses technology to make instant offers on homes. The process is designed to be quick and convenient for sellers, who can avoid the traditional hassles of listing their property, showing it to potential buyers, and negotiating a sale. Opendoor purchases the home, makes necessary repairs and renovations, and then lists it for sale on the open market. The company's revenue comes from the service fee it charges sellers, as well as the profit it makes on the resale of the home. This model is heavily reliant on data analytics and algorithms to accurately price homes and predict future market trends. The appeal of this model is its potential to streamline the real estate transaction process, making it more efficient and transparent. However, it's also a capital-intensive business that carries significant risk. Opendoor has to hold a large inventory of homes, and any downturn in the housing market can lead to substantial losses. While many investors are drawn to the tech aspect of the business, it's important to remember that at its core, Opendoor is a home flipper operating on a massive scale. For those considering an investment, it's worth exploring how this model compares to more traditional real estate investments available through platforms like Fidelity or Interactive Brokers. The most recent earnings report from Opendoor provided a mixed picture. While the company beat revenue expectations, it missed on earnings per share. More concerning was the guidance for the upcoming quarter, which fell short of analyst expectations. This has raised concerns about the company's ability to achieve profitability in the near term. The earnings call revealed that while the company is making progress in reducing its costs, it's still facing challenges in a tough housing market.
The high interest rate environment has made it more expensive for Opendoor to finance its home purchases, and it has also dampened demand from potential buyers. The company's management has emphasized its focus on operational efficiency and a data-driven approach to navigating the current market. However, the market's reaction to the earnings report was largely negative, with the stock experiencing a significant sell-off in the days following the announcement. This underscores the market's sensitivity to any signs of weakness in the company's performance. Looking at the institutional ownership of Opendoor, it's clear that there's a significant amount of smart money invested in the company. Major players like Vanguard and BlackRock are among the top shareholders. However, there has been some notable selling from institutional investors in recent months, which could be a red flag. The fact that some large funds are reducing their positions suggests that they may have concerns about the company's future prospects. On the other hand, the presence of well-respected institutional investors can also be seen as a vote of confidence in the company's long-term potential. For individual investors, it's important to understand who is buying and selling the stock, as this can provide valuable insights into the market sentiment. Many online investment platforms and brokerage services like Schwab Intelligent Portfolios provide tools to track institutional ownership, which can be a useful resource for those doing their own research. Comment below with your thoughts on the future of the iBuying industry. Do you think Opendoor has what it takes to succeed where others have failed? The future outlook for Opendoor is highly dependent on a number of factors. The direction of interest rates will be a key driver of the housing market and will have a direct impact on Opendoor's business. If the Federal Reserve begins to cut rates, it could provide a significant tailwind for the company. However, if rates remain elevated, it could continue to be a headwind. The company's ability to successfully implement its AI-powered strategy will also be critical. If the new CEO can deliver on his promise to use technology to improve the company's efficiency and profitability, it could be a major catalyst for the stock. However, if the strategy fails to deliver, it could lead to further disappointment for investors. The competitive landscape will also be a factor. While Opendoor is the last major iBuyer standing, it still faces competition from traditional real estate agents and other online platforms. The company will need to continue to innovate and differentiate itself to maintain its market position. Ultimately, the story of Opendoor is a classic case of expectation versus reality. The expectation is that the company will disrupt the real estate industry with its technology-driven approach. The reality is that it's operating in a challenging market with a business model that has yet to prove its long-term viability. The recent volatility in the stock price reflects this tension. For investors, the key will be to look beyond the hype and focus on the fundamentals. While there is certainly a great deal of potential in what Opendoor is trying to achieve, there are also significant risks. The path to profitability is likely to be a long and challenging one, and there will be bumps along the way. Whether those bumps are temporary setbacks or signs of a more fundamental problem remains to be seen. The current market action suggests that investors are becoming more discerning and that the company will need to deliver tangible results to justify its current valuation. The wide range of investment sites and the rise of self-investing have made it easier than ever for individuals to take a position in a company like Opendoor, but it has also made it more important than ever to do your own due diligence and understand the risks involved in any investment, whether it's through a traditional brokerage like Fidelity Investments or a newer platform like Robinhood.